Welcome to MyFinJourney, the podcast that breaks down the barriers of traditional finance and explores ways people are growing their wealth. People often think you need money to make money, but what if that isn't true? Whether you have a lot of capital or just a little, you can participate in strategies that challenge conventional wisdom and create opportunities for financial growth. Today, I'm joined by Pascal Wagner, and I'm really excited for this podcast because we're going to dive deep into his journey to really understand what got him to where he is today, what takeaways there are for the audience, and where he's looking to go in the future. Pascal, welcome to the podcast.
Hey, thanks for having me on, Mustafa.
No problem. So I want to dive right in. I want you to share your journey in an elevator pitch, if you could, for the audience.
An elevator pitch. I can tell you when I was 23, I started in real estate. I started buying single family homes that rented by the room. I started a couple venture-backed companies and then eventually started working for a venture capital firm called Techstars, where we deployed capital into early stage companies. While I was there, my dad passed away from old age. My dad was the one who managed all of the finances in the family. And so my mom, being 65, didn't really know much about finance or money or investing. And me having had more experience in that space, it was my turn to step up. First thing I did was I invested in what I knew would bring cash flow, invested in more of these single family homes that I rent by the room. I call it co-living. I have 11 homes in Atlanta, 94 units. I've been doing that for over a decade now. At one point, I realized I can't have all of my mom's retirement in this one asset class, in this one city, with this one strategy. I reached out to a couple different financial advisors. I at least 3 financial advisors, and I didn't get good answers. Most of them were like, here are different things we can do in the stock market. And so that didn't sit well with me. I reached out to other people I knew who were retired and living off their income. I'm a part of a mastermind group called GoBundance. Many of the guys there lived off of their passive investments. And so I learned where were they investing, what to look for, things like that. I basically refinanced the money out of my single family home portfolio and started redistributing it across what is now 23 different passive investments across all different types of asset classes. We're talking self-storage, retail, restaurant, oil and gas, multifamily, private credit, private debt. I did developments. I've done value add. I've done a whole gamut of different strategies. Throughout that process, I was constantly hungry for information. I joined a bunch of different forums and groups, and I realized there were a lot of people who taught you how to raise money or be a real estate operator yourself, but there were very few that taught you how to be a professional LP investor. If I knew what I know now, I would probably have at least $1 million more to my net worth. That's what's led me to where I am today.
I love it. Thank you so much. I feel like there's so many different things I could zoom in on. So I guess first off, you had that professional experience in Techstarter, investing in early stage startups, which a lot of people would say this like high risk investment, angel investing type, 1 in 10 type strategy. Your father passed away, and I'm sorry to hear that that was an event that changed it, and the wake up call to say, hey, I need to change how I'm managing the portfolio. For a lot of people, something happens in life that changes how you look at money. I'm sorry to hear that it was something so sad. But the good thing is that it forced that responsibility to say, hey, what is the most efficient way to grow my mom's wealth? And also recognize that she's probably in a different position than you are, both mentally in terms of age and what makes sense for her portfolio. And then it's interesting that you went down the concentration risk avenue, because correct me, Pascal, you also talk to a lot of entrepreneurs and business people. I think a lot of people fundamentally go that concentration risk isn't bad because I'm investing myself in the product that I manage, etc. So help me understand, were you still at Techstarters during this time? And why did you conclude that diversification was the right play in this situation?
Yeah, look, I think I'm a huge advocate for betting on yourself. And I think most people agree. Having control over your own future, your destiny is a basic human need. At that stage, we were making $250,000 from the portfolio net. And what you quickly realize is that it's a business and businesses carry risk. You just need to have a bad month or something goes sideways. I had a tree fall on one of my homes and it was a $65,000 insurance claim. I've had a multitude of different issues. And when those things hit your cash flow, you start to realize, oh crap, this is not as desirable as I thought. I think it's also like future planning for my mom, right? I don't want to be in a position where stuff goes sideways and my mom loses a bunch of that money. A hurricane could go through, and even though I have insurance, that whole portfolio could get wrecked, as we've seen happen to a lot of properties in Florida. I think you grow your wealth through concentration and you keep your wealth through diversification. The dream there was be in all different asset classes across all different operators, across a bunch of different strategies that help me diversify the income that my mom is receiving so that it won't just go away or one event will destroy her portfolio.
I love that. Especially, I want to reiterate what you said about growing your wealth through concentration and keeping it through diversification, because this is a concept that most people don't know or realize or recognize, because entrepreneurs are forced fed invest in yourself and employees are forced fed diversification. And there is no middle ground. Like everything in life, it's just like my narrative is right. But I think the devil's in the details, and it's to say, get to your number and then diversify for peace of mind. And that peace of mind is worth something. Everything carries risk, whether it's a business or working for somebody, everything really does carry risk. And you want to be in a position where you can quantify that risk for yourself and make a sound, intentional decision on how to grow your family's portfolio. So I really appreciate the wisdom, Pascal. One thing I wanted to better understand from your perspective is your experience with financial advisors. And this isn't necessarily to knock any industry. It's just to better understand, like, you were at Techstars. What exactly were you doing there?
My role at Techstars was the problem that Techstars had. So
Sure.
they have multiple $100 million plus funds, and Techstars is mainly known for, they invest $120,000 into 10 early stage companies in a cohort. That cohort would come into an office for 3 months, get a mentorship and guidance, and we'd help them get a bunch of traction, help them raise money, and then kind of shoo them out of the nest. Techstars had, I think at this point, they have over 3,000 companies that they've invested in. Techstars raised a new $150 million fund to do a follow-on investment into the top 10, 20% of the portfolio companies that went through the original accelerator. The problem was you have 3,000 companies where they're all raising their next round of capital at different times. Techstars doesn't immediately get alerted that they're raising a round. In the documents that they sign, the founders, according to the law or the contract they signed, it says they need to notify us, but in reality, that doesn't play out.
Yeah.
My role was to first figure out who were all the companies that were raising rounds at any given time, and then apply an investment thesis that the team had already raised the $150 million fund on. We will never lead a round, we'll only follow. We never want to be the largest check. Our standard check's always going to be 150. There are all these programmatic rules about when we will not participate. And so that kind of gave me this understanding of a thesis and also helped me understand the value of deal flow, right? So it wasn't just, hey, I get an email in my inbox for a deal, and then I'm trying to decide, do I like this? It's more of, okay, I am seeing 100 deals this month, and I have a filter system that automatically says yes or no to the round criteria. And then of those that met that criteria, we would hand select which ones we would do a follow-up investment in.
So if I understand this at a 5th grade level, fundamentally, you are a professional investment analyst for alternative assets. At a very watered down, and maybe at a 1st grade level, you looked at amazing things. You figured out what was the coolest. And these are things not available to the public market.
Exactly.
And so that's very different than a financial advisor, who, as I understand it, they only sell what's available in the public market. So let's say you're going to buy I don't know, a Porsche 911 GT. You could go and buy it at the Porsche dealership, or you can go and buy it at the auction. The auction is much cheaper. Most people don't know how it works, etc. But the dealership is easier, more accessible, feels nicer. But there's a markup. Does that kind of sound right? Just summate the difference between the two?
Yeah, I think that's a good comparison.
Okay. And what was your experience working with that financial advisor? I've equated them to a Porsche dealership, so I'm not trying to have any negative bias. But you went to a financial advisor first. You're obviously very knowledgeable. You know how to advise the right things. You're very good in personal finance and investment grade analysis. So why did you go with a financial advisor first?
I think anytime I'm in a new situation, I'm looking for guidance. I'm looking for people who have dealt with the situation that I'm in, people who have more experience than I do, even though I might have some. I also thought to myself, I would feel like an idiot if I didn't talk to a couple and I made wrong decisions versus I went and talked to a couple and then decided not to. I think part of the issue was that the more you get into finance, you just learn everyone is selling their own products. What I didn't like about the financial advisors I spoke to is that they didn't have my kind of wealth. I want to learn from people who've done it, who understand. You might know that from a theory-based level, but that wasn't quite what I was looking for. I think that was point one. And then point two, I think, is they promote the products that they have. And they get incentivized, and their commission structure is based on how much of a certain product they sell. But I think it's important to sit back and realize that, understand, okay, what are the dynamics at play here? They all want to put your best interest at heart. They're also not going to work for free.
I love that. And I think it's a great time to pause and just say, if you like this podcast, leave a 5-star review, hit subscribe, share it with your friends, because we all have to sell our own product. And in this situation, Pascal and I are both selling financial literacy. It's almost free, but it does cost you time, which is arguably the most valuable asset you have. So yeah, Pascal, 100% agree with everything you're saying. I think from my perspective, it's interesting because it shares a similar mentality of just saying, hey, I might be very good at what I do, but I don't know everything. So how can I learn? How can I become 1% better? And how can I apply that to whatever I'm working on, whatever the problems? In this situation, it's like growing well. But then you touched on something that needs to be elaborated further. The idea that my financial advisor, who is very knowledgeable and good at what he does, may not be me. They may not be in the same position as me. They may not have clients in the same position as me. So if you're if you're somebody who's making $250K passively or borderline passively or through cash flow through the assets you manage, that could be more than your financial advisor is making. It's not just saying that they don't have financial wisdom to solve your problem. It's to say they might not be best fit, and it might be better fit to find that one financial advisor that has a higher percentage of clients like you. And that's what I'm hearing between the lines to say, hey, I want to find the right network. You mentioned masterminds, networking groups. I want to understand from your perspective, Pascal, when did you realize the value of networking, of masterminds, of looking for people that know more than you? Because for a lot of us, we don't come out the womb with this mentality of, let me learn from other people. It's let me learn from school. And that's about it. I'm not really going to learn from people. But then something changes. I want to understand what changed from your perspective.
Oh man, I've always been on that trail. When I was 23, my best friend, Diego Corzo, heard about a group called GoBundance on a podcast, and he went and volunteered, and he called me and was like, Pascal, you got to get involved in this group. And for context, like GoBundance is, you have to have a certain net worth to be a part of the group. And it's around being like a well-rounded man. We call it like being a whole life millionaire, not just in money. And I was 23. I was like dirt poor. And I just wanted to be around these people. I picked them up from the airport. I got them coffee. I did whatever I needed to do to be of service. Alex Hormozi has this term that's, I have knowledge debt. And my goal is to pay down that knowledge debt as quickly as possible. And you can only do that through other people, or books, people who've been there.
I love it. Being a part of masterminds and hustling to learn more and grow. And that knowledge is so important for you. What I'm curious to understand is, from your perspective, what is the best way for you personally to learn and grow and leverage mentors? Is it speaking to them, books, podcasts? Is it something else?
I think it depends on the problem that you're trying to solve. A mentor is helpful in the way that they can look at your exact situation and coach you based off of context. I've hired a coach and I've had mentors. Podcasts and books are great for piecing together a larger picture or having the knowledge base. Right now I'm geeking out about funnels. And so I'm reading all these different authors about how they think about marketing and funnels. And it helps me see it from a bunch of different perspectives. But then to have a coach that can sit down and say, this is the one tweak you need to make that I had a blind spot around. I think that's where they all come into play in different ways.
And for you, when you think of coaches, mentors, books, podcasts, however you're learning, do you have a set number or percentage of cash flow or money that you make every year that you invest in these types of growth strategies to grow yourself? Or is it more, hey, this resonates, this coach seems good, or I feel like I have this deficit. Let me just figure out how to improve and let me intentionally throw money at this problem until I find the right tools?
I've never had a percentage or dollar amount. I think it's more around seeing the opportunity and figuring out how to get there. So like in a couple examples I have. When I was in college, I was very interested in marketing and entrepreneurship. There was a guy named Eben Pagan who taught how to do it. And he had this $5,000 conference at 19. I sent a video to their team and applied for something. I got to go to this conference where I was surrounded by 500 entrepreneurs who paid at least $5,000 to be there. And like in the early years, I found that everyone wants to help the young person. And so I think I went to at least 7 conferences for free. I would say, hey, I'm young. I would love to be here. How can I help? I'm happy to help set up or whatever you need. I'll be there. I just want to be there and absorb. And they'd be like, we'll just give you a free ticket. The cost thing is always, I pay, it depends on the opportunity and what resources you have. But I think it's more about if I thought something was valuable and would help me be better, it wasn't, oh, I don't have the money. It was, okay, I'm going to figure out how to learn this, get there, be there, whether I pay a small portion or I volunteer or and I figure that out.
I love that because I think it's a very unique story that you don't hear that often about the hustle, the grind, making it happen, even if you don't have money. Like I mentioned earlier, some people feel like you need money to make money, but it's like either you have money or time. You need to figure out which you have, the person you're talking to, how to pitch them, how to have a conversation with them. It's to say fundamentally that you took a page out of Win Friends and Influence People. You figured out how to be personable, how to align interests and be in a position to get what you wanted. Now, from your perspective, Pascal, did you learn more from those free courses or events, or did you also value it versus the things that you paid for? There's a narrative out there that you only value things if you pay for it. So I want to hear from your perspective if that narrative holds true or if it depends on the person.
I think it depends on the opportunity. I've had things I've spent money on. I paid over $30,000 for 6 months of coaching with this coach. And I will tell you, it was the worst use of money that I spent. I'm
available if you need a coach. Let me know.
Because I wanted to know what it was like to work with a higher end coach. And I think it really matters. Problem fit makes a big difference. I've had a coach that I started out free with, and he gave me this idea like, hey man, I don't know if you value this. I'm going to start charging you for it. And I still pay him to this day. 5 years later. And then there are those free things. I don't know if I got more or whatever value. I think I was in all different stages. I think at the beginning of my journey, when I just volunteered and tried to be in these rooms, I don't know if I got an ROI. Half of it is I didn't know what I was doing, didn't know what problem I was trying to solve. I was trying to absorb. Looking back, you can see, oh, I took that away or that was helpful. You don't really know what you don't know at the beginning.
And I think that's a very good point that you mentioned, right? You say that let's say 19, you pick up a skill or something, it informs the way you make a decision later down the line. But it can be hard to point to it always from that conference that I went to that was free versus a conference that was $5,000 or $100 or whatever. There was something else that you mentioned, Pascal, earlier that I thought was really interesting. It was to say, hey, I'm making a lot of money from my portfolio, let's say $250K net. And then I believe you went and you took leverage on the portfolio to diversify. So for some people, they're concerned about cash flow. They just want to make as much money in their pocket. Other people are like, let me leverage the sucker as much as I can. And I guess maybe there's some people in the middle in theory. I only meet people who are at either extreme. So I want to understand, you went from in theory, a position where you had strong cash flow to a position where you had less cash flow. Maybe your dad had just passed away at that time, from my understanding, maybe after a couple of years. Did that feel like a lot of debt to take on? What was going on in that situation from your perspective that led you to decide to do this?
Yeah, we bought the whole real estate portfolio in all cash. It was the cash flow that was supporting our family. I had to make the decision, okay, I need to, it really just felt like we are one mishap away from this hurting our portfolio. A couple things fluctuate and you go from 250 down to 220, and it starts to open your eyes about, okay, these things can swing. It is still a business and it has risk. What I didn't appreciate back then is the velocity of deploying capital in fifth grade terms. If you have, in my case, it was several $1 million. So let's call it like 4 million. To deploy 4 million is actually really difficult to do quickly. So looking back, I wish I stuck them into these debt funds and they would be earning some interest and I could pull money out as I found opportunities. After I refinanced the portfolio, I had a whole bunch of money sitting in cash. At that time, treasuries were still less than 1%. Inflation was rampant. You do investments at a 50 or 100K slug, you're going to need to do a lot of investments in order to invest that capital. And I was scared. I didn't want to make mistakes. I didn't want to lose the money. It was like a new skill. And although I had experience at Techstars, it's still a different type of investing. Yeah, I think there's a lot to be said for going about it slowly. I was just under a huge time crunch.
I love it because there's a lot of intentionality there. You share a lot of wisdom that people who need it don't often hear this type of wisdom, because it's in a very, let's say, atypical situation you're in, where you're sitting on a lot of money and you're like, hey, there are no opportunities. Meanwhile, if you ask me, or if you ask Pascal in 2025, he'd be like, no, there's tons of opportunities. You just need to know where to place it, the list. It's that easy. Just if you went to that financial advisor, they'd be like, you have the whole market. There's so many opportunities. You can buy this product, life insurance, etc. But it's to say, when you're sitting on that money, whether it's 4 million, 10 million, you have a $25 million exit, whatever the situation is, for a lot of people, that's the first time you're seeing that much money. And you're like, okay, now what? You can't go to your friend and say, I have a money problem. I'm sitting on too much money. People will look at you like, that's not a problem. You're like, no, it is opportunity cost, setting up my family, building generational wealth. These are serious things. And you work hard to build that nest egg. So no, man, I hear you, Pascal. And I really appreciate that you shared that vulnerability of feeling scared and unsure, because I think we all hit that at different points in our lives in different situations. And it's what you do to take that first step that really makes the difference. So if you were to give Pascal Jr., the younger version of yourself, advice sitting where you are today, what would it be when you're facing those financial decisions that make you afraid or make you scared? What would you say is that roadmap to make things more manageable?
I think it's a similar route of find someone who's done what you're trying to do successfully and absorb from them. You can't invest without the knowledge, and you'll make less mistakes by having a guide. I think those are the first steps.
Beautiful. I love it, Pascal. Thanks again for joining us on the podcast. If you found value, please do leave a 5-star review, share it with your friends. I'll include Pascal's information in the show notes so you can also connect with him. Once again, thanks guys for your time.